Welcome back. We are busy with Class 7 investments. We are now looking at Unit 2.5 of our current session, and we will be discussing financial instruments. Right, financial instruments that you can find in the money market, all instruments including certificates or deposits and commercial papers which repay the lender within a year are called money market instruments. Right, let's have a look at the various instruments. Banker's acceptance. A banker's acceptance, or a BA, is a bill of exchange drawn on and accepted by a bank. The maturity period is usually between 30 and 120 days. The most popular period is 90 days. The face value is the amount the investor will receive on the maturity date. Short-term finance may come in the form of an overdraft or a bank acceptance. The interest rate will dictate which option is most cost-effective. The fixed rate of the banker's acceptance is preferable to fluctuating interest rates on an overdraft, but if funds are needed only intermediately over, say, 30 or 120-day period, an overdraft may prove to be cheaper. A drawer applies for a credit acceptance from a bank. The banker accepts the bills by signing across the face of the bill, and the drawer can then sell them at a ruling discount rate. Let's just have a look at banker's acceptance. Banker's acceptance are no longer issued or traded in South Africa, though they are still used in other countries. Let's have a look at an example. Let's say your period of investment is 92 days. The initial nominal amount or face value is 1 million rand. The borrower then receives 980,000. The borrower then pays the investor at the end the million. The yield on the investment in this scenario would then be 8.10%. Another one is a treasury bill. A treasury bill involves a short-term debt instrument by the government, which usually mature or have maturities of 91 to 182 days. Treasury bills are issued for two main reasons: to fund part of the government budget deficits and monetary policy. They are an essential source of information, as interest rates on treasury bills serves as a benchmark indicator of money market conditions and act as a reference rate for calculating interest rates on several other money market assets. Financial institutions consider these bills as liquid assets, and because they involve government debt, they offer excellent security. They are readily negotiable and offer good short-term investment opportunities. Treasury bills are discount instruments. The tender is sold at a discount rate that is worked out as a percentage per annum of the redemption price. The discount acts as an insurance of interest to be earned on a loan to the value of the discounted price paid by the investor. All prices are quoted in rands and cents. For example, a 92 rand and 61 cent. For every 100 rand face value, the purchaser will then pay 92 rand and 61 cents. The formula used to calculate these price for the treasury bills is price equals the redemption value minus the discount rate times days divided by 365, being the days in the year. Note, the yield the investor receives is higher than the discount rate. It is because the yield is a percentage of the purchase value and the discount rate is a percentage of the redemption value. Right, let's have a look at promissory notes and commercial papers. A promissory note is an unconditional promise in writing made by one person to another, signed by the maker, who agrees to pay on demand or at a fixed or determinable future time a certain sum to a specific person or order or bearer. A bank is usually approached to endorse the note. Banks will accept a promissory note in lieu of funds as an alternative to overdrafts or loans. A promissory note does not affect the bank's liquid assets as alternatives do. The bank discounts the note on the open market and the bearer is then paid the face value. The debt will appear as a liability only on the maturity date. Banks must reflect their dealings in promissory notes on their balance sheets. Right, a negotiable certificate of deposit or NDCs, negotiable certificate of deposit or NCD is issued as a receipt in bearer form for time deposits. They are liquid as a negotiable asset and offer a market-related interest rate. They are payable to the bearer but must also be made out to a specific person. The institution issuing the certificate undertakes to pay the deposit amount plus interest to the holder on maturity. They are normally issued for less than a year, but banks tailor the maturity period to the needs of their clients. NCDs are not eligible for a discount at the Reserve Bank, but they remain very popular due to their higher yields, negotiability, and status as a claim on a bank. The formula to calculate the value is as follows. Maturity value is equal to the amount invested times, big brackets, 1 plus small brackets, days divided by 365, close the brackets, times, open the brackets, rates, divide by 100, close the brackets, close with big brackets. So that's the formula to calculate a NCD. Right, then you get short-term debentures. A short-term debenture is an investment where the borrower issues a certificate specifying a fixed interest and a nominal investment amount to the investor. The investor provides the borrower with an amount and receives the nominal amount plus interest at maturity. These debentures are usually for the 3 months and are issued by the Reserve Bank and other corporate companies. Then you get your notice deposits. There's no specific due date for the deposited funds, but a period of notice must be given before withdrawing the funds. Rates are automatically increased, but investors are informed of any decreases with the same notification period before the decrease. Then you get your call accounts or deposits. Money is deposited in an interest-bearing account and can be called back on demand. Typically, the more considerable the amount invested, the higher the interest rate. Interest rates are subject to daily fluctuations. Interest is calculated on a daily balance and paid out monthly. Then you get your fixed deposits. The investor places funds with an institution for a fixed period. Let's say, for example, anything from 3 months to a 24-month period. Then you get your linked deposits. The investor invests the money for a fixed period, but the rate is linked to the prime rate. If the prime rate moves up, the investor receives more interest, whereas if the prime rate moves down, then obviously the investor receives less interest. Then you get your savings and fixed deposits. The investor places money in a savings account with a bank and receives interest monthly. Interest rates is not very competitive and merely offers the client a short-term solution. Savings accounts are mostly used to save small amounts and are popular with elderly investors. The investor can access the fund anytime and can even draw a check against such an account. Although checks these days aren't really used anymore. Let's have a look at the JSE Limited's classification system. By allocating companies to specific sectors or subsectors, the JSE aims to create homogeneous subsectors so that companies in the same subsector can be expected to react similarly to political and economic events. In January of 2006, the JSE introduced a 4-tier system to replace the old 3-tier system of share classification. The 4-tier system breaks the market listings down by industry, super sectors, and then subsectors. But the JSE indices, the JSE published information on share prices and indices each day to reflect the movement of share prices on the JSE. An index is a barometer or indicator of the movement of share prices. It allows the individual to measure performance and make comparisons. Each sector of the JSE has an index. Various sectors are grouped into broader indexes to give a broader view. The indices compares today's prices against yesterday's closing prices. The performance of one sector can be compared to another, and by checking the performance of a particular share against the index for its sector, an investor can see if that share is doing better or worse than the average share for that specific sector. The management and the composition of indices used by the JSE were revised in 2001 and brought into effect on 2nd January 2002 to bring them in line with the international standards. The indices are now called the FTSE or JSE Africa Index Series. The FTSE stands for Financial Times, FTSE, FTSE. These indexes are designed to measure the performance of the African market, major capital and industrial sections or segments. The FTSE JSE Africa Index Series indices are in 10 different categories. These indices may be grouped into the following categories. Headline indices. 5 indices make up the headline series, all share, the top 40, the mid cap, the small cap, and the fledglings. Then your tradable indices, in addition to the top 40, there are 5 other derivative indices based on classification of companies under the FTSE Global Classification System. The FTSE JSE tradable indices are calculated in real time and published every 15 seconds. Then you get your all-share economic group indices. The FTSE Global Classification System consists of 3 classification levels. At the highest level, there are 10 economic groups. The classification of the all-share index constituents at an economic level and is used to calculate the sector indices. The all-share sector indices, the next level of the FTSE Global Classification System is sectors. The classification of the all-share at the sector level is used to calculate the sector indices. Then you get the all-share sub-sector indices. The final level of classification is subsector. Using the classification of the all-share at the subsector level, the 6 sectors that make up the mining sector will be calculated as indices. Then you get your secondary markets. The South African market has 3 separate secondary markets: the development capital, venture capital, and alternative exchange. Indices are calculated for these secondary markets. Then you get your specialist indices. Several specialist indices are included. Their constituents are not limited to all share or any specific industry sector. Right? Which is the institutions and players in the stock market? The market composed of buyers and sellers of securities. The main participants in the stock markets are large financial institutions, who are the large buyers and sellers on the JSE Limited, your brokers who make the transactions on behalf of buyers and sellers and earn a commission. They can also act in a dual capacity as an agent and as a principal. And then government acts as in 2 capacities: as a market regulator through legislation and a seller of security to raise money for the implementation of government monetary policy. In the 3 main categories of investors who are subsets of the above are dealers or speculators. The main aim of the speculator is to make a capital gain over the short and medium term. Income from dividends is seen as irrelevant. Profits made by an investor who has been termed as a trader by the receiver of revenue are taxable in the year received. The so-called bulls and bears are the 2 main types of speculators. A bull buys shares hoping to sell them at a profit. They trade on price advances. A bear sells shares not possessed at the time to repurchase them at a lower price before the date of settlement arrives. They trade on price declines. Another speculator is the stag, who buys shares offered to the public for the first time, hoping to sell them at a profit as soon as they are listed. Then you get your investors. The investor buys shares in the hope of enjoying long-term capital growth and long-term growth in dividend income. Capital profits of this nature are not taxable. if they have been held as a long-term investment, but they are taxable as capital gains. Inflation-fighting investors may not be interested in dividend income but buy shares to protect their capital against inflation. To avoid being classed as a dealer, the reason for investing should be given as a long-term investment. Investors should remember reinvestment income as share prices increase and so do the dividends. Income growth combined with capital growth is a powerful way of accumulating capital. Investing in equities is one way of protecting one's capital against inflation. Still, a direct holding of shares is a high-risk investment that requires a good knowledge of the stock market to be successful. Right, if we look at the valuation of equities, the basic principles affecting the fluctuation of prices of shares on the stock exchange is that of supply and demand. If the demand of certain shares is higher than the supply, one can expect those prices to rise. If the supply for certain shares exceeds the demand, one can expect those prices to fall. Price fluctuations can also be affected by business cycles. In the upswing phase, business activities increases and there is likely to be more demand than supply of good shares, which will generally increase the price of the shares. The downswing phase will have the opposite effect on share prices. As the mood of the investors become more pessimistic, business activities decreases and the demand then declines. Right, a report and rumors can often have a sudden and dramatic effect on the prices of shares. Thus, psychological factors such as anxiety or optimism for the future can also play a part in decreasing or increasing the share price. Three major categories of equity valuation models are the following. Your discounted cash flow technique. These models estimate and secure the intrinsic value at the present value of the future benefits expected to be received from the security. In the discounted cash flow calculation, benefits are often defined as cash expected to be distributed to shareholders. Then you get your relative valuation models. These models are based mainly on share price multiples. These models estimate the intrinsic value of a share from a price multiple for some fundamental variables such as earnings, dividends, and cash flows. And then you get your asset valuation models. These models estimate the intrinsic value of a share from the estimated value of a company's assets minus the estimated value of its liabilities. This approach is based on the theory that the value of a business is equal to the sum of the value of the company's assets. In a field of competitive as the investment management, there is a continuous search for those factors which will lead to outperformance. Such factors are, for example, shares with low price earnings ratios and shares whose book value exceeds their share price. These models are typically constructed using historical data. 2 points are often made about such models. Firstly, the past may not be repeated in the future, and secondly, if one model works, will the others not use it and arbitrage the advantage away? Right, let's have a look at fundamental analysis. In fundamental analysis, the analyst analyzes the fundamental factors underlying a particular enterprise or company and focuses on three areas in particular, namely your economic trends, the industry in which it is, and then the company itself. This analyst makes use of ratios as an aid, which is especially useful in determining whether a company is profitable compared to other companies in the same sector. The analyst also uses variable and various models to determine whether the expected return is sufficient compensation for the expected risk, namely the expected return on a share, the expected internal rate of return, the dividend discount model, and the proprietary in-house valuation models. We look at technical analysis. Technical analysis is the visual study of how prices move and provide the analyst with a summary of the market perception of future price movements. There are three major factors to remember when studying modern technical analysis, namely, markets are inherently efficient and thus take all their fundamental factors into account. Prices move in easily identifiable trends, and human nature and psychology determine cycles, meaning history will always repeat itself. Technical analysis measures the effect of certain events, while in contrast, fundamental analysis measures the cause of an event. These are interwoven and cannot be measured independently. There are several technical analysis theories which are as follows. The first one is the Dow theory, which focuses on three trends in the stock market. Volume flow confirms the direction of the trend, and the trend must be assumed to continue until there are proven signals for its reversal. Then you get the Elliott wave theory, which indicates that stock markets reflect recurrent rhythms or cycles that repeats indefinitely. And then you get the Kondratiev wave theory. It identifies three cycles in the US economy, each of which lasts about 50 years. Right, let's have a look at the random walk hypothesis. So far, we have assumed that market prices individual securities logically. Not everybody accepts this. Some argues that tomorrow's price is independent of today's or of yesterday's price. A monkey throwing darts at a page of share prices is as likely to perform as well as most investment managers. It is known as the random walk theory. At the start of the century, a French mathematician, Louis Bachelier, argued in his doctoral thesis the theory of speculation that past, present, and future events are reflected in the current market price. When changes occur, they occur randomly. The probability of prices going up is the same as the price going down. That is a 50-50. And no one knows in which way they will move and when they will change. The speculator has an equal chance of winning and losing. Mathematically, the expectation of speculators is therefore zero. Research has shown enough anomalies to cast doubt on the random walk theory. Small capitalization shares tend to outperform large capitalization shares. In his book, What Works on Wall Street, James O'Shaughnessy shows that selecting shares by different criteria produces different results. Sometimes the differences can be or are dramatic. How does one calculate a fair price to pay for a share? Right, so you can calculate it based on dividend yield. The last column gives you the dividend yield of that share. Let's say the dividend yield is dividend paid per share for the past or the latest financial year. You divide that by the share price, multiplies that by 100. The dividend yield column gives the company's dividend yield, that is the cash paid out to shareholders per shares as expressed as a percentage of the price. The other method is price or price earnings ratio. The PE ratio refers to the price per share divided by the headline earnings per share. For example, if a share is priced at 100 cents per share and it earns 10 cents per share, the PE is 100 divided by 10, which is then equal to 10. The price is taken on the publication date and the earnings are given annually in the company's financial statements. The results of this calculation is to show the number of years future earnings that are bought today. You may pay more than you should for a share because you believe it will produce substantial earnings in the future. For example, the PE column gives you the price earnings ratio of the share. It is the company's current price dividend by the headline earnings per share. Remember, the PE is based on historical earnings and is a number which indicates the number of years earnings would require to pay for. The share at its current price, however, what often interests investors are the future earnings. The PE can also be calculated by dividing 100 by the earnings yield. Right, let's have a look at earnings yield. The earnings yield is the inverse of the PE ratio and shows the yield percentage at the current share price. You take the earnings per share, divide it by share price, and multiplies it by 100 to work out the earnings yield. Right, earnings per share or EPS are the total earnings divided by the number of shares outstanding. Earnings per share are generally considered to be the single most crucial variable in determining a share price. It is also a major component of price to earnings valuation ratios. EPS is the profit attributable to ordinary share dividends by the weighted average number of shares. It is the profit attributable to the holder of one ordinary share. Right, let's have a look at instruments for hard assets like rare coins. The collection of rare coins is very exclusive and demands a high level of expertise. Coins are valued according to the age, but could also have value. Minerals, imported coins are subject to value added tax or VAT. Then you get your gemstones you can invest in. Gemstones are aesthetically appearing, rare, durable, and of high quality. These characteristics distinguish them from minerals. 90 of these 1,000 minerals have attained investment status. 10 most popular stones for collection are diamonds, rubies, emeralds, sapphires, tasfurite, aquamarine, tanzanite, blue tourmalines, red tourmalines, and green tourmalines. The gold. Many South Africans have invested in gold for years as a hedge against inflation and political uncertainty. Traditionally, they did this by buying Kruger rands. The value of a Kruger rand is determined by the several factors, including the dollar price of gold. They are more secure than direct investments in gold and mining companies, as their value is unaffected by local disturbances. The rand-dollar exchange rate and the premium at which the coin trade above the value of the bullion content also impact the price. The number of coins minted by the Reserve Bank determines the premium. The fewer coins in circulation, the higher the premium. The 1 ounce denomination is the most sought after. Gold is purchased to hedge against the rand's declining value on international markets and inflation. Today, it is also possible to buy gold bullion in bar form. Previously, it was illegal for South Africans to do this. Right, and the last item we're going to discuss in this session is future contracts. The investor can buy commodities utilizing future contracts for agricultural and mining activities. The investor does not have to take delivery of his purchase and can sell it without owning it. What to look out for when investing in hard assets? It is essential to do a proper research, and it's advisable to consult a professional before a hard asset is purchased. Investors should be wary of unscrupulous dealers. Investors must be patient, as the asset may take a long time to appreciate. Investors should at least like what they buy and make sure it suits their lifestyle. Thank you very much for attending this session. The next session we'll be moving on to Unit 3, where we will discuss the different types of investment vehicles. Thank you. So see you in our next session.